Most people think Disney is just a mouse, a castle, and some overpriced popcorn. But if you look at their 2025 audit, you'll realize the mouse has developed titanium teeth. We found a financial engine under the hood that is generating more cash than some small countries. Today, we're peeling back the curtain on why Disney is no longer a story stock, it's a cash printing machine. Welcome to Flywheel 2.0. Let's talk numbers, but in human terms. Disney's net income didn't just grow, it exploded by 149%. That's $12.4 billion. To put that in perspective, that's enough money to buy every single person in New York City a brand new Tesla and still have change for lunch. The big takeaway, the money they used to burn on getting subscribers, is finally coming back home. But it's not all fairy tales. Disney has a hole in its pocket the size of a crater, and it's called cable TV. As people cut the cord, the old-school TV business is shrinking fast. But here's the twist. For the first time ever, their streaming profit is growing fast enough to catch the falling knife of cable. It's a high-stakes race between the past and the future. How did they fix streaming? They stopped being the, quote, cheap alternative. They raised prices, and guess what? You stayed. International revenue per user grew by 19%. It turns out, when you own the childhood of half the planet, you have massive pricing power. They aren't just selling shows. They're selling a digital membership you can't quit. If streaming is the shiny new toy, the parks and cruises are the family farm. This segment is a $10 billion profit beast. Even with slightly fewer people visiting the parks, the ones who do show up are spending 5% more. It's the premiumization strategy: fewer crowds, higher prices, happier shareholders. Look at this radar chart. This is Disney's DNA. Netflix has great tech, and Universal has great parks. But only Disney can take a character from a movie, put it in a cruise cabin, sell the toy in a park, and then stream the sequel to your living room. It's an ecosystem that digital-only companies simply can't touch. Every hero has a villain. For Disney, it's not a rival studio, it's Gen AI. Imagine a world where anyone can create a fake Mickey movie for $5. It threatens their exclusivity and creates a legal nightmare. AI is no longer a tech buzzword. For Disney, it's a Tier 1 existential threat to their copyright empire. In the arena of entertainment, Disney sits in the God mode quadrant, high scale and high margin. Netflix is bigger in pure streaming, but they don't have the physical assets. Disney's diversity is its shield. When movies fail, the parks save them. When the parks are closed, streaming carries the weight. 2026 is going to be a year of heavy metal. We're seeing 3 new cruise ships hitting the water. They are doubling down on what works: physical experiences that you can't download for free. Plus, the standalone ESPN launch in late 2026 will be the final piece of the digital puzzle. Disney stopped gambling. In 2023, they wasted over $2 billion on content that failed. In 2025, that number dropped to almost zero. They are pivoting to quality over quantity. Expect more sequels, more Moana, and more Mufasa. It's predictable, yes, but in business, predictable is profitable. Let's look at the family cookie jar. With $18 billion in operating cash, Disney is doing 2 things: building more stuff, CapEx, and buying back their own stock. A $7 billion buyback is management's way of saying, we think our stock is cheap, and we're betting on ourselves. The mouse is entering the public domain. As Steamboat Willie loses its copyright, Disney is entering a new era where they don't own the past exclusively anymore. Combine that with 231,000 employees who want higher wages, and you see the friction. Disney is a giant, but giants are heavy and expensive to move. Think of cable TV like an old car that's running out of gas. Disney knows it's dying, so they are harvesting the last bits of cash from it to pay for the electric future. Selling off Star India was the first step in cleaning the garage. They're getting lean, mean, and digital. The bottom line? Disney isn't a growth stock anymore. It's a value powerhouse. They've survived the streaming wars, they've optimized their parks, and they have the best IP in history. The flywheel isn't just spinning, it's accelerating. In 2026, the mouse is the one to beat. If you want the full-page data pack behind this analysis, head over to HDINResearch.com. We do the deep digging so you don't have to. For custom audits or market research, shoot us an email at sales@hdinresearch.com. Thanks for watching.